Hi, welcome to Investors Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. So in this episode, we'd like to review some of the Chinese trade performance, especially under President Trump's tariff regime in the past few months. And joining us today is our global market strategist, Jennifer Qiu, who recently wrote a piece looking into some of the more recent Chinese numbers, but as well as the longer term trends when it comes to Chinese exports. So Jennifer, welcome to this podcast.
Thank you, Tai. Thanks for having us.
So let's start with the high level picture. We've just had the August trade numbers out of China. What's been the performance like with all the trade barriers from the US so far? Any noteworthy trends in terms of Chinese export partners?
Right. Thank you, Tai. Well, to be honest, Chinese exports, it's done pretty well so far this year. Earlier in the year, we saw a lot of front loading ahead of the prospective President Trump's tariffs. But then after that, the payback effect from these front loading has been pretty mild. Exports continued to grow in the subsequent months. In July, we saw the growth was at 7.2% on a headline basis. In August was slightly disappointing, but still nonetheless resilient at a 4.4% growth. And to your second part of the question about the trends, there is actually a pretty clear divergence in export destinations if you look at Chinese exports. For example, growth in exports to the US fell a lot. But that was actually more than offset by growth in exports to Africa, to ASEAN, to a lot of these emerging markets. And this trend actually continued even in the latest August numbers we saw last week. The exports to the US was especially weak. It fell 33% year over year, especially because of the sentiment boost from the US-China trade truce actually started to fade. And that's actually the fifth month of a double-digit decline already. But this divergence in this composition of China's trade export partners, we think it will likely stabilize looking forward. It won't continue in that extreme. There's this idea of a narrowing China to rest of the world tariff differential. As we all know, the rest of the world got hit by President Trump's reciprocal tariffs earlier in August. So now everyone else's tariff rates got raised. So the difference between China's 43% effective tariff rates and other countries' tariffs that they're facing from the US, this gap has actually narrowed. And this relative tariff is actually pretty important to consider when we think about future growth or declines in US-China trade. So we do think that this decline will probably start to slow and stabilize a bit in the second half of the year. And then on the other side, when you think about China and EM trades or ASEAN trade, we saw a transshipment crackdown as a very key element in the US-Vietnam trade deal. And so if this really becomes a blueprint for future trade deals with other ASEAN countries, that growth in terms of China-ASEAN trade could see some risks of slowing down as well. So that's what we're thinking about the composition of trade. But in terms of overall trade, we think it will likely remain still resilient in the short term, growing maybe perhaps at low single digits as we're seeing. But as you know, we're already seeing some signs of slowing in the August trade numbers. And looking forward, if global demand weakens or once all the front loading really comes to an end, we could see some risk of further weakening as well.
Well, I think your point about global demand is really important because ultimately, of course, a lot of attention has been put on tariffs and trade barriers, but it's also worth highlighting that if you look at some of the recent US numbers or even just global growth numbers, we're seeing some moderation in growth momentum. So that could also impact on exports. The other point to bear in mind also is the fact that the summer months are typically the peak season of trade because we're getting ready for the year-end festivities, whether it's Christmas or Thanksgiving, et cetera, et cetera. So then from that perspective, I think these few months in terms of export performance is also really critical, reflecting, at least from a retailer perspective, what they expect to see when it comes to final demand of consumers, not just in the US, but really around the world. But also, I think another point that I think you mentioned is really quite interesting is the tariff differential. Because of course, in isolation, 30%, 40% tariff seems very high. But if everyone else is still getting 20, 25, 30%, I think that differential narrowing, it does play back towards China as a manufacturing hub, especially considering some of the advantages that Chinese exporters have when it comes to logistics advantages, when it comes to the economies of scale, et cetera, et cetera. So I think from that perspective, I think the trade tariff policy so far, the net impact on China, as you rightly mentioned, is much more manageable. So let's come back to one point that you mentioned a little bit earlier, which is the issue of transshipment. There's been a lot of discussions on China's exports to another market as a stopover before reaching the US or the ultimate destination. And as a result, this so-called transshipment trade was part of the, for example, US-Vietnam trade deal. Have we seen any shifts on this transshipment in recent months?
Right. Yes, you're right, Tai. Transshipment really is very key for China's future trade outlook. It was a very important backdoor, a very important channel back then in the 2018 trade war we saw for China's exports to really remain resilient despite all these external challenges. But I guess the first question really is to think about how serious are transshipments nowadays. Our investment bank, for example, estimated that 60% of that growth in exports to ASEAN were actually transshipments. And indeed, if you really graph together Vietnam's imports from China together with Vietnam's exports to the US, these two lines move quite in tandem, to be honest. But that's really just on a top line level. If you look at a level deeper, for example, if you look at HS, 4-digit product code, for example. And you can see that actually growth in Vietnam's imports from China were mostly integrated circuits, display monitors, really intermediate goods, while Vietnam's exports to the US were mainly driven by growth in computers, in smartphone trade, etc. So one can also argue that there was some sort of transformation or value add being done within Vietnam, so it's not purely just transshipments. But here I have to be honest with you, Tai, it is quite challenging to really differentiate between pure transshipments versus really legitimate supply chain shifts. And that's why even if you look at the US-Vietnam trade deal, it's not really clearly defined in terms of how transshipments are being measured and really defined in that way. But apart from like definition, implementation details are also not very clear at the moment in this trade deal. Is it by using rules of origin in terms of regional value content requirement, or is it in terms of matching your HS product codes, or is there a surveillance list of products that they monitor, etc.? We're not quite sure at the moment of how these transshipment crackdowns will really be implemented. But nonetheless, you can imagine with a 40% transshipment tariff, transshipped goods through Vietnam will face over 70% tariff at the end. So economically, that just doesn't really make sense for exporters. Exporters would rather just export directly from China and face that 41% instead of really transshipping. And then your last part of the question is about whether we're seeing it in the data. And honestly, not really. So these transshipment tariffs actually already came into effect August 7th. But actually, if you look at the August print, China exports to Vietnam actually still continued to grow at double digits. So there could be a couple of reasons. It could be really genuine demand from Vietnam remains pretty strong, or just still some of this lingering transshipment is still happening amid a lot of that unclear uncertainty in that transshipment definition and implementation details I mentioned about. But in general, as I mentioned before, if this transshipment tariff really is a blueprint for trade deals with other ASEAN countries, especially where we're looking at Malaysia, Thailand, etc., that could still pose pretty material risks to China's exports in the future.
Well, I think if you look back to the data in the last few months, not just for August, what you find is that a lot of companies or even a lot of countries, they're sort of adopting the wait and see approach. They're not shifting their supply chain in a material way because frankly, they're not quite sure whether some of these tariff policies could stick. For example, the courts in the US ruled against President Trump's some of his tariff policies. So this could go all the way to the Supreme Court, and we still don't know what the final ruling is going to be. So instead of reacting to every shifts in policies, that obviously is going to be costly and time consuming. I suspect many companies are simply just adopting to what we have right now and just keeping the supply chain as is. But I think the other point that you've made is really interesting and really important, and that is the rules of origin. Because, for example, as you rightly pointed out, increasingly more components are coming from China, and these are assembled in Vietnam, and these products are exported as the final products. There should be sufficient value add to qualify those products as made in Vietnam. Now, the transshipment accusation that we often hear about is simply Chinese-made products in Vietnam just got stamped with made in Vietnam and then get shipped to the US. Obviously, how the US customs determine these rules of origin or the definition of transshipment, as you rightly said, is not super clear. But I suspect over time, we will see a more even distribution of value add across different markets over the same supply chain. So again, that's, I think, one way for companies not just to address the tariff issues, but also really diversify the supply chain. As we've seen in the past, natural disasters, pandemic have created bottlenecks in supply chains. And this type of diversification serves not only to reduce or minimize tariffs, but also to diversify and minimize potential supply chain risks going forward. So Jennifer, another question that we've been getting a lot is whether all these new tariffs against China could force Chinese exporters to seek out other markets, whether it's in Europe or other developed economies or emerging markets. Clearly, as you mentioned earlier, we've seen some of that. But I think the question really is, are Chinese exporters selling their products to these new markets in a very cheap, very competitive way that's creating deflationary pressure on these new markets, or squeezing the profit margins of local producers in these new markets? What's the data telling us?
Yes, Tai, I think this is really a genuine concern from a lot of other markets. It's really a key driver behind, for example, the anti-dumping duties that EU placed on Chinese EVs last year, because a lot of these countries are just worried that China are so-called exporting deflation to their own countries and hurt their domestic industry. And one way to look for this in data is sometimes to look at export prices. So if you think about China's PPI, producer prices, it has been in deflation territory for 3 years. And not surprisingly, export prices have also fell pretty dramatically since 2023 because of a lot of the excess manufacturing capacity that we're seeing on the news now. But it might surprise you that actually export prices have increased in recent months in CNY terms. This means that actually Chinese exporters didn't actually lower their prices intentionally to gain market share. They didn't need to, more like, because partly there was the CNY depreciation we saw on a trade-weighted basis this year that really helped enhance those export competitiveness, partly also because those ex-US demand for Chinese exports were really quite resilient. So Chinese exporters actually didn't really lower their prices in terms of selling their exports out. So for now, you can say that global spillover from Chinese deflation has been quite mild. Most of that impact probably is just because of the currency, instead of Chinese exporters really actively lowering prices. But really looking forward, there's also the anti-involution policies now to help control these downward price pressures. So hopefully in the future that can still alleviate part of that issue as well.
So with all that in mind, I know the tariff really has been only kicking in for or discussed for the last 5 months. But if we take a longer term perspective, what does it all mean for Chinese exports or Chinese trade, the long-term outlook of it?
Yeah, on this topic, one data point we always talk about is how China's share of U.S. imports have fallen from a peak of, say, 21% to now at around only 9%. But China's share of global trade has been pretty stable, if not having risen quite a bit actually since 2018. So yes, we think that supply chain diversification will continue. It's been ongoing for many years, not just because of tariffs, but this China dominance in manufacturing and trade, we don't think it's that easy to break. We don't think US tariffs now will cause a significant shift away from China as a manufacturing base, because to be honest, relocation costs are very high. And the current China versus rest of the world tariff differential is just not really that much high enough to really justify moving all of the production away from China. And as Tai, you also alluded to, China has a lot of advantages in manufacturing. It's low cost but very skilled labor, low cost capital, really great infrastructure, very well established supply chains, really enabling that economy of scale. So in general, long-term wise, we do think China's dominance in trade and manufacturing will continue. Of course, de-risking will also continue in terms of supply chains, but not complete decoupling.
So wrapping everything up, what does this mean for investors? I think what you've touched on is, again, this is a really important point. I think people have not quite absorbed yet, and that is tariff has risen for most countries or most economies or trade partners with the US. In the past, people often only think about US-China trade relationship, but this time around, everyone has seen higher tariff rates when they want to sell to the US. So in that sense, on a net basis, China is not suffering as badly as people think, and the supply chain shift may not be as rapid as people think. But from an investor standpoint, what does that mean? What should investors do? How should they deal with these uncertainties when it comes to trade, or from a China perspective?
Right, Tai. Honestly, this year, market sentiment towards Chinese equities have really recovered quite a lot compared to the past 1 or 2 years we've seen. MSCI China, for example, rallied over 30% year to date already. And a lot of that came from the AI tailwind from earlier in the year, but also, as you mentioned, that sentiment boost from a relief in this US-China trade tension. And honestly, Chinese GDP growth has been pretty resilient as well. First half has been logging a 5.3% growth, despite all of the external challenges, although a lot of that growth did come from strong export performance. If you think from a macro picture first, we do think that GDP growth will likely slow in second half of the year. A lot of the consumption stimulus on trade and subsidies, especially, and as well as the export growth, probably all of these tailwinds would start to fade a little bit, and structural changes do take time. However, I think for the Chinese economy, Chinese market, the overall environment remains pretty benign. We are past peak US-China tension, so tail risks have been more or less removed. Policy is moving in the right direction, although magnitude-wise, some might say it's disappointing, it's relatively incremental, but nonetheless, this supportive policy stance in general will put a floor on the market. And China is still quite underowned by international investors, valuations are still reasonable, and a falling US dollar could actually provide support as well. So in general, we do think that, yes, there are still uncertainties looking forward, but still, for example, a lot of these fundamental factors still are supportive, and not to mention a lot of exciting themes like AI, robotics, etc. So we do continue to see opportunities in this market, but really going into uncertainties, we have to emphasize the importance of active management, definitely.
Thanks, Jennifer. I think the last point is absolutely crucial in terms of active management, because even before Liberation Day, we've always argued that tariffs will impact on specific sectors in the US and globally, as well as in China. For example, the service sector typically suffer less when it comes to tariffs because President Trump's view on tariffs is mainly on goods and less so on services. And at the same time, as you rightly pointed out, and again, something that we've been highlighting for the past really 1 to 2 years, is the fact that if you look at MSCI China or many of the Asian markets, you find that domestic companies drives a lot of the earnings growth. And therefore, domestic economic development plays a more crucial role in driving the long-term earnings performance of these markets, including China. And as you rightly pointed out, there are new themes when it comes to artificial intelligence, when it comes to new consumer spending patterns, when it comes to, for example, the profitability or the anti-involution or anti-excessive competition behavior of companies. All of that creates new opportunities in investing in China. So I think from that perspective, of course, the Chinese markets, both the A-share markets and the H-share markets, offshore markets, they've come a long way. But I think overall, there's still plenty of opportunities in these markets. We just have to, sector by sector, company by company, to explore those opportunities. So Jennifer, thank you very much for your time today.
Thank you for having me, Tai.
And thank you for listening. If you enjoyed this podcast, please share this with your friends and colleagues. And of course, consider subscribing. If you have any questions, feel free to reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I look forward to see you next time to discuss what's on the investors' minds. And meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.